In this video, we will discuss an introduction to options. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I'm currently the chair of Accounting and Financial Management at the Graduate School of the University of Maryland, University College. There are two primary types of options, calls and puts. Calls give the buyer the right, but not the obligation, to buy a product for a set time at a set price. Puts give the buyer the right, but not the obligation, to sell a product for a set time at a set price. The fact that you have the right, but not the obligation, is one of the things that distinguishes options from futures. If you sign a long future, you are obligated to buy. If you sign a short future, you are obligated to sell. Calls and puts are more like buying insurance products, and whoever creates and sells them to you, the short, is more like the insurance company. This underlying product can be a stock, a bond, a commodity, a piece of real estate, or many other items. The profit from the ownership or being long a call is going to be minus C naught, the call premium that you purchase from the insurance company for, plus the maximum of S minus X comma 0, where S is the current market price or the closing market price when the call expires of the underlying stock or other commodity. X is the strike price that you have the right to buy it at. In the case of buying a call, you of course hope the stock price goes up. In the case of buying a put, the profit for a long put is minus the call premium, what you pay the short to purchase the put from, plus the maximum of X minus S comma 0. If you are long a put, you are hoping the stock price goes down. Calls are commonly used for things like incentive call options for management of companies to align their interest to the same interest of the stockholders in the company. Puts, on the other hand, are for speculating the market will drop, are very much like insurance. They are called sometimes portfolio insurance. So if you own the S&P 500 and you think the market's going to drop, but you don't want to sell, maybe for tax reasons, you could buy a put, and if the stock market drops, you lose money on your stocks, but you make money on the put, which cancels it out. Therefore, puts are even more like insurance products. You pay the put premium to the insurance company, which then takes on the risk of the stock market dropping. We can calculate the break-even points and the maximum profits for calls and puts, again by looking at these equations. For the break-even point, we set profit equal to 0. We solve for S by taking the two negatives to the other side, and therefore the break-even point is S equals X plus C naught. For a put, we will set this equal to 0, and we will find the break-even point moving S to this side is X, the strike price, minus P naught. The next step is to get the maximum profit for a call or a put. Well, the maximum profit for a call would be the stock going to infinity. Therefore, long calls can make an infinite amount of money, so short calls, those that create and sell it, can lose an infinite amount of money. Most of the people that create a call or short a call own the underlying stock. If you sell a call and you don't own the underlying stock, that is called a naked call option, which is a very risky strategy. The maximum profit for a short call is very similar to being an insurance company. The maximum the insurance company can make is the premium you pay to buy it. They hope you don't wreck your car, and they keep the premium. For puts again, the break-even point is the strike price minus the put premium. The maximum profit for a put is going to be when the company goes bankrupt and S goes to 0, so the maximum long profit is going to be X minus P naught. That then would be the maximum loss for the short put. And the maximum profit for the short put position is also the put premium, P naught. That is obviously what the insurance company would make the most, their premium, nothing beyond that. Why would you buy an option? Well, calls, again, are purchased when you think the stock market is going to go up, when you're incredibly bullish. It's a way of leverage in the market, like you could before the Federal Reserve created the 50% leverage requirement. Therefore, it's a pretty risky strategy, since due to the time value of money, each day you own a call, it loses value. So you have to be sure that the stock market will go up, and it will go up very quickly. Puts, again, are purchased as insurance against a price dropping. If you were smart and you had bought puts before the huge stock market drops in 2000, again, huge or around 40% drops in 2007, you would have made money on the puts, or if you owned the underlying stocks, at least you wouldn't have lost money. The graph of the payoff for a long call option looks like this. It's nonlinear. Again, if the stock closes below the strike price, in this case 40, and you buy the call, you lose all of the money you invest, in this case $200. If the stock price goes up above the call, and it's above the strike price plus the call premium, then you make money, potentially an infinite amount of money. For a long put, again, you want markets to drop, just like you do with shorting a stock. If the stock price stays above the strike price, in this case 30, and you buy a long put, you lose all of your money. If it drops below the strike price 30, you can make money if it drops below the strike price minus the put premium. In this case, the put premium is about $250. The short call is the opposite, just like the insurance company. The maximum the short call can make is its premium, in this case $200, and of course they can lose an infinite amount of money as the stock goes up. For a short put, again, the purchaser of the put hopes the stock market drops. The maximum they can make if the stock market drops is going to be the strike price minus the put premium. The maximum, again, the insurance company that sells it can make is the put premium, which is around $250. Now we will discuss the time value of options. Options in many ways behave like insurance products. If you buy car or home insurance, a year of insurance is going to cost more than 6 months of insurance. And if you get a reimbursement from the insurance company, the value of that reimbursement will decrease each day as you approach the expiration of the insurance. This value of the insurance product or option is called the time value. So options, whether calls or puts, have an intrinsic value plus a time value. The intrinsic value of a call is the value on the day of expiration, s minus x comma 0. The intrinsic value on a put is the value on the day of expiration, x minus s comma 0. To that, you add the time value to get the total value. So in an insurance product, one of these being profitable or positive would be the same thing as your house already burning or your car already being wrecked. And then this is the possibility of that happening over the next 6 months or a year. We can see a graph of this for a call option. This line here is the intrinsic value, 0 or s minus x, and to that we add a time value to get the total value of the call option. And each day, this time value will decrease until on the day of expiration, the value of the option is just the intrinsic value. Again, for a call, if the stock price is down here below the strike price, that would be out of the money. If the stock price equals the strike price, that's at the money. And if the stock price is above the strike price, that is in the money. For a put, you have this relationship. Again, we have x minus s comma 0. So on the day of expiration, you have this final line here. The day you buy it, you have a more curved line because you add in the time value. And as you approach expiration, the value of the option decreases until again on the day of expiration you only have the intrinsic value, which for a put is x minus s comma 0, where in this case the strike price is 17. To get more of an intuitive idea of the way options behave, we can look at the way call and put options, the price of them or the value of them will change with these variables. The stock price S, the strike price X, the timed expiration T, the risk-free rate in the market, which is roughly the value of the US Treasury bill, and the volatility, how much the underlying stock goes up or down. So for a call, you want the stock price to go up. So as the stock price goes up, the call value goes up. For a put, it's the opposite. You want the company to go bankrupt. So as the stock price goes up, you lose money. As the stock price goes down, you make money. The strike price is the right you get to buy at for a call. You want that as small as possible, or sell at for a put. So for a put, you want that as high as possible. Since these are both insurance-type products, the longer to the expiration for both of them, the more valuable they are. For the risk-free rate, the call gives you the right to buy something. Well, if the risk-free rate is high, you can keep money in the bank and earn interest on it and delay buying it, and that makes the call more valuable. For a put, you're going to sell something, and if you're selling it, you're going to get money and stick it in the bank. So the higher the risk-free rate is, the stronger your incentive is to sell it, and therefore as the risk-free rate goes up, the put value goes down. Volatility is like risk. The more the underlying stock goes up or down, the more likely it is to expire in the money, and the more risky it is for the seller of the call or put, and therefore the more valuable the call or put is. The insurance analogy for this would be a risky driver, somebody with a bunch of DWIs, is going to pay a lot more for insurance than a safe driver. Again, the variables here are the stock price, the strike price, the risk-free rate, such as the US government Treasury bill, the timed expiration, and the volatility are how much the underlying asset moves up or down. By going to a broker such as E-Trade, we can show how options behave consistent with the past table. For example, this is the S&P 500, the spiders, and at this point in time, they had a spot price, the current stock price of 311.09, and we can look at how the value of both calls and puts are going to change as the strike price changes. So for a strike price of 309, calls are going to be in the money and are over here. Here's the last price. Puts are going to be out of the money, and here is the last price. Now, as the strike price goes up, the price that you get to buy at for a call goes up, then you would expect the value of the call to go down, which it does. As the strike price goes up, you would expect the value of the put to go up, which it does, because for a put, this is the price that you get to sell at. We can also examine the same relationships with respect to the timed expiration T. At the top, we see options that expire on December 4th. At the bottom, December 6th, so a little bit later. So for a strike price of 309.5, we would expect the options here to be worth less than the options here, which they are, and this should be the same whether these are calls or puts. The same for a strike price of 312. The options here are worth less than the options here. So the longer to expiration of the option, the more valuable it is going to be. An equation on how to value options was developed by Robert Merton, Fisher Black, and Myron Scholes in the 60s and 70s. Interestingly, options are valued using an equation of thermodynamics from the late 1800s. So Merton, Black, and Scholes realized that the movements of stocks in the stock market very much resembled the movements of particles, for example, in the stellar atmosphere, and they applied the physics of thermodynamics to the stock market. Merton and Scholes received the Nobel Prize in Economics for this in 1997. Fisher Black had already died in 1995, but was mentioned as a contributor to this research by the Swedish Academy. The equation they developed, at least for call options, looks like this, where the value of a call option is the stock price times this, which is the normal distribution of D1, minus the normal distribution of D2, times the present value of the strike price. On the day of expiration, of course, the value of the call option will just switch to N minus K, where K is now the option strike price. D1 is this rather interesting equation, the natural log of the stock price over the strike price, plus the risk-free rate, plus the volatility, standard deviation squared, or variance, divided by 2, times the time to expiration, divided by the volatility, or standard deviation, times the square root of the time to expiration. D2 is just D1 minus the standard deviation times the square root of the time to expiration. How to use this to value options is discussed in another video. I thank you for watching this video on option valuation.